Today we're going to talk about something that's been making headlines lately, the US debt crisis. Now this might sound complicated, but we're going to break it down in simple terms. The truth is, this isn't just a political or economic issue. It directly impacts your wallet, your savings, and your investments. If you've heard about the US national debt climbing past $32 trillion and wondered what that really means for you, you're in the right place. In this video, we'll cover what the debt crisis is, why it matters, and how it could affect everything from the stock market and inflation to your retirement funds. By the end, you'll have a clearer idea of how the US debt crisis impacts your investments and what steps you can take to protect yourself. So, let's get started. 10. What is the US debt crisis? First off, let's define what the US debt crisis really is. In simple terms, it's the enormous and ever-growing amount of money the US government owes to others. Right now, the national debt is over $32 trillion, and it's only going up. The government borrows money from foreign countries, banks, and domestic investors just to cover its expenses. The problem? This debt is growing at a rate that's becoming unsustainable, and it's starting to affect the economy and your finances. The US government has been running deficits for years, meaning it spends more than it earns through taxes and other revenue. To make up the difference, it borrows money. Over time, this creates a mountain of debt that's tough to handle, and it's a long-term issue that can affect things like economic stability, inflation, and even how much you'll pay in taxes in the future. 9. How did the debt get so high? The US national debt didn't accumulate by accident, but is the result of various factors over time. One major contributor is military spending. After the September 11th attacks and during the wars in Iraq and Afghanistan, the US spent trillions on defense, significantly driving up the debt. Another factor is tax cuts. While the idea behind these cuts is to stimulate economic growth, they also reduce the government's revenue, making it harder to cover its expenses. Social programs like Social Security, Medicare, and welfare initiatives are also substantial contributors. As the population ages, the demand for these services has grown, further increasing government spending. Finally, the COVID-19 pandemic led to massive stimulus spending, including unemployment benefits and direct payments to citizens, which added trillions to the debt. Each of these factors, from military expenditures to social programs and emergency spending, has played a role in swelling the national debt over the years. 8. The interest burden. A growing problem. One of the most concerning aspects of the debt crisis is the cost of servicing that debt. In simple terms, the government has to pay interest on the money it borrows, and that interest isn't cheap. Right now, interest payments on the national debt are over $400 billion a year. That's money that could be spent on infrastructure, healthcare, education, or other important areas. But instead, it's going straight to paying off the debt. This interest burden is only going to get worse as the debt continues to grow. And as the US borrows more, the interest payments could end up taking up a larger share of the federal budget. This is a real concern for your investments because when a government has to allocate so much money just to pay interest, it has less room to invest in economic growth. 7. Government spending cuts and their impact. So how does the government address this growing debt? One of the options is to cut spending. If the government slashes its budget, this could mean less money for social programs, defense, and infrastructure projects. While some might see this as a good thing, lower spending means less borrowing, it can have serious consequences for the economy. Cutting government spending could lead to slower economic growth. For example, cuts to social programs could hurt the most vulnerable people in society, while cuts to infrastructure projects could stifle job creation. For investors, this means that sectors like healthcare, defense, and infrastructure might not perform as well, potentially affecting your stock portfolio. 6. The impact on interest rates. As the US government continues to borrow more money, it has to attract buyers for its debt. This means the US has to offer higher interest rates on Treasury bonds to make them more appealing. But here's the catch. Higher interest rates don't just affect government debt. They impact everything from mortgages and car loans to business loans and credit cards. For investors, this can be a double-edged sword. On one hand, Rising interest rates could lead to higher returns on bonds and savings accounts. On the other hand, higher rates could make borrowing more expensive, which could slow down consumer spending and business investments, leading to a dip in stock prices. For anyone invested in the stock market, this is something to keep an eye on. 5. Inflation and the U.S. debt crisis. Another major factor that comes into play with the U.S. debt crisis is inflation. As the government prints more money to cover its debt, it could devalue the dollar, leading to inflation. This means that the cost of living increases, everything from groceries to gas gets more expensive. For investors, inflation is a big concern because it erodes the purchasing power of your money. If inflation is high, the returns on your investments might not stretch as far as they used to. Inflation also impacts the bond market, as the value of fixed-rate bonds decreases when inflation rises. If you're not careful, inflation can eat into your long-term investment gains. 4. How the U.S. debt crisis affects the stock market. So how does all of this affect the stock market? When the government is in debt, it can cause uncertainty, and uncertainty is not great for stock prices. Investors may become nervous about the future of the economy, leading to more volatility in the market. Additionally, if the government raises taxes or cuts spending to manage its debt, it could reduce corporate profits, which in turn could lead to lower stock prices. If you're invested in the stock market, the debt crisis could mean more ups and downs, making it harder to predict where your investments will go next. 3. The potential for a debt default. One of the most extreme consequences of the U.S. debt crisis is the potential for a debt default. This happens if the government is unable to pay its bills and defaults on its debt obligations. While this may sound unlikely, it's not entirely out of the realm of possibility. If the government defaults, it could cause a financial panic, disrupt global markets, and even lead to a recession. For investors, a debt default would likely lead to a sharp decline in stock market values, and it could severely damage the reputation of U.S. debt. If the U.S. can't meet its debt obligations, investors may pull back from buying U.S. bonds, leading to higher interest rates and even more economic turmoil. 2. How can you protect your investments? So, what can you do to protect your investments during the U.S. debt crisis? First and foremost, consider diversifying your portfolio. A mix of stocks, bonds, and other assets can help spread out your risk. It's also important to keep an eye on inflation and interest rates, as these will have a big impact on your returns. Another smart move is to invest in sectors that are less sensitive to government debt, like healthcare, utilities, and consumer staples. These sectors tend to perform better during economic downturns because they provide essential goods and services. The bigger picture, long-term solutions. While it's crucial to understand the immediate impact of the U.S. debt crisis on your investments, it's equally important to think about the long term. The government will need to make some tough decisions to address its debt, whether that's by raising taxes, cutting spending, or finding new ways to grow the economy. For now, the key is to stay informed, stay flexible, and adjust your investments accordingly. All right, that wraps up our deep dive into the U.S. debt crisis and how it affects your investments. The debt is real and it's growing, but by understanding its impact, you can make smarter decisions about your money. Keep an eye on inflation, interest rates, and government policies. These will all shape the future of the economy. If you found this video helpful, don't forget to like, share, and subscribe for more insights on how economic events shape your investments. Thanks for watching and take care of your money. 1. China, the biggest loser. When it comes down to it, China was probably the biggest loser in Trump's trade war. While China still maintained strong economic growth during this period, the tariffs and other restrictions hurt its industries, especially those reliant on exports to the U.S. companies, also began shifting production out of China to avoid tariffs, further weakening China's dominance in manufacturing. Even after the Phase 1 trade deal, the damage had been done. China faced a shift in the global supply chain that could take years to recover from. So, there you have it. Trump's trade policies created a complex web of winners and losers. While some industries in the U.S. saw growth, others faced higher costs and disruptions. And on the global stage, countries like China were forced to adapt to new trade realities. What do you think? Were Trump's trade moves a success, or did they cause more harm than good? Let me know in the comments below. Don't forget to like, share, and subscribe to the channel for more in-depth discussions on global politics and economics. Thanks for watching, and I'll see you in the next video.